Welcome, everybody, to this fun deep dive live, and thank you for joining us today to discuss two of our fixed income strategies, the Simplify Aggregate Bond ETF, ticker symbol AGGH, and the Simplify Treasury Option Income ETF, ticker symbol BUCK. A couple housekeeping items to start with. The chat is disabled, so please submit your questions into the Q&A section. And always, this is not meant as investment advice and for entertainment purposes only. My name is Jason England. I'm the Managing Director and Portfolio Manager in Fixed Income Strategist here at Simplify. And I'm delighted to be joined by Shailesh Gupta, the CIO of Structural Alpha and Portfolio Manager.
Hello, everyone.
Let's go ahead then and dive right into it. Shailesh, we got a lot to cover here. We have obviously two funds, so we have some good material to go over. So I'm going to start out with, let's just kind of, start out with AGGH as the first topic. As you can see here, we'll go back a little bit. We'll start off with performance, then we're going to go through the process and a little bit of positioning. And I'll ask some questions to Shailesh and let him kind of go through it. So starting out with, we can just see that, the performance is held up well over time since inception. It's outperforming the ag. We'll go into detail of why that performance is worked out so well over the since inception and the year-to-date numbers. Going a little bit in the process. Really, the essence of this strategy is just really trying to replicate the core bond strategy, but taking advantage of structural alpha opportunities to enhance yield and maximize return with more efficient option writing and curve positioning. We start with a core position of the AGG ETF, somewhere in the 90 to 95% range, and then we'll seek to enhance yield with the structural alpha of options and futures. As you can see here, since inception, we've got a 1.29% annualized alpha versus the index through beginning in November. It's still sitting right around that same area. And really, as I said, there's kind of three areas of the portfolio that we kind of look to kind of, there's that core position of the ag, but then we can also at times will pivot around. Shailesh will find, buy bonds with the best and highest risk-adjusted yields. So at times we may underweight that ag position and overweight in certain sectors, whether it's agency MBS via TBAs or whether it's TIPS if the relative value on real yields is attractive. So those are some opportunities. And then we'll always try to set the duration using interest rate futures so that you can have a similar risk profile of what the ag is kind of the goal here. And then the final that we strive to enhance yield. And that's really kind of been the core focus this year, where we're doing the risk managed option selling program.
Right. I'll elaborate a little bit on the
Yeah.
option selling strategy, which has been consistently adding value to this portfolio. And as we notice, the structural alpha opportunities add to the returns even when the beta is not making money. We saw rates were rising over last 2, 3, 4 years. However, the option yield strategies, which is basically dependent on the interest rate options in the US market, on an average trade rich because of the hedging demand from the mortgage market, so and so, right? So options are helping enhancing the yield. And while going forward, we are expecting the Fed to be reducing rates towards, general consensus of around 3% over next year or so. In that environment, yields are likely to be sort of range bound to maybe declining a little bit. So in that environment, the beta itself should be, generating decent amount of return, and on top of that, these alpha opportunities will enhance the yield further without increasing the credit risk.
Yeah, and I think that's a key point, Shailesh, is that people see that the yield is pretty high right now, and I know I've had questions that, are you leaning into high yield or leaning into credit, or are you leaning into going down the cap structure, and that's how you're getting that higher yield. But as you just described, it's really coming from that option income on treasuries. Um, so you're really looking at just government risk. So there is, obviously the government can default, but it's the risk-free rate, and so it's not. We're able to attain this yield without leaning into credit, and I think that's the key, differentiator between our core bond strategy and a lot of the others out there. Most of them you see they'll overweight, whether it's leaning into, credit, whether it's investment grade or high yield, but they'll also lean into non-agency mortgages, and that's something that we're not doing in this strategy.
Right. So any yield strategy is basically monetizing the convexity of the underlying market variable. So, a credit yield is basically, enhancing the yield from the underlying credit risk, whether, the convexity in the credit market, right? However, our yield enhancing strategy is from the convexity of the interest rate market. So when we have reasonable amount of certainty where the rates are going, then the option strategies, can be a very good way to enhance the yield without without increasing the credit risk.
Okay, perfect. Why don't we go through a little bit of the current positioning. I'm going to pull up the slide deck again, and maybe you can break down kind of the opportunity set that you see right now. Obviously, the option strategy you've been going in depth about is kind of one of the main levers you're pulling, but maybe break down the current positioning to kind of give us an idea of where you feel the opportunities in fixed income are right now. We're getting a lot of it, investors reaching out, obviously, with, like you said, the Fed is in an easing path right now. It's been a little bit of a start and stop, and whether they do anything at the December meeting, we don't know. But the direction of travel looks like they are going to continue to ease and get closer to the, whether it's 3.5%. People debate where the neutral rate is, but with that backdrop, what's the opportunity set in the positioning in the portfolio right now?
Right. So other than the opportunistic views, one of the other areas which add value, in the fixed income market is that the US Treasuries trade at a higher yield than interest rate swaps. There's high level of demand for duration from the pension liability industry. So the interest rate swap trade at a lower yield. So positioning one versus the other can further enhance the yield without, taking additional credit risk. Credit risk is the U.S. Treasury. If one has to worry about the credit risk of U.S. Treasury, then there will be much more different risks we would have to worry about than the underlying risk in the U.S. Treasuries.
Perfect. Okay, so that kind of gives a backdrop of a high level view of AGGH and a little bit of the positioning around it. And as we said, AGGH is more that, the beta or core position is the ag, with these structural alpha opportunities on top of it. Now we have another strategy that takes advantage of those same structural alpha opportunities, but the beta or the core positioning is actually a money market or T-bill type underlying holdings, is really more the collateral that we're trying to enhance with the option selling strategy. And so that's our BUCK strategy. So
So
we
in
can dive into
AGGH, we
that
have
next.
noticed that the treasury options are increasing, helping increase the yield of the ag portfolio. Our investors who do not want the ag exposure, just want to enhance the yield of T-bills, that treasury option income strategy, we are also making it available in the form of BUCK. Right. So AGGH is a much more, I mean, it has more levers to pull in terms of various directions, but the best one among them currently is Treasury option income. And that specific strategy is being used to enhance the yield of T-bills in BUCK.
Perfect. So let me pull up some of the slides and we can go through that a little bit, just kind of high level. So the obviously, as you said, it's the core positioning is treasury bills or money market like securities. So it's really just a yield enhanced um, treasury bill fund. And really another key here is too is different, slightly different. The ag is obviously we don't have egg-like duration. We're running, the underlying holdings are treasury bills or money market securities with a duration up to 1 year. So targeting a duration of 1 year or less in here. And then the key is once again, we're using that treasury option income strategy. So, you're not taking credit risk in the portfolio to attain the yield in there. And then doing those same structural alpha positions in here as well, that option selling program that you've discussed. And really just trying to target a yield much higher than treasury bills and trying to enhance that. And so those that want to step out of money markets into like that ultra short or short duration space, a lot of times in that space they're really going to lean into credit to try to get extra yield. Here we're using the option selling strategy as we discussed. So that is another lever that you can do without really using credit risk in the portfolio.
Right. So
um,
let's discuss the option strategy a little bit, more in detail. That obviously any strategy, there's no free lunch in the market, right? So if you're taking convexity risk, so risk is basically sharp move in rates, up and down, so to say. So if one look at the second order risk, the chances of rates coming down to 3.5% is probably higher than rates going to 4.5% from the current level of 4%. So we choose the options in such a way that in case due to Fed rate cuts, if the rates, the Treasury rate, the 10-year rate starts going towards 3.5%, then that doesn't offset the gains from the options or the duration of the ag portfolio, so to say. So the risk, the portfolio in option strategies, like you are selling calls and puts, right? So in the selling calls can be a correlated strategies to credit risk, like a COVID kind of a scenario happens where credit securities are losing money and the treasury rates suddenly go down. In those scenario, the treasury calls can lose a lot of money. So that's why we skew the portfolio more towards the put side. And calls typically are done in a covered call manner that in case there's a sudden sharp decline in rates due to any flight to quality kind of a event, the portfolio is protected. So hence, both these strategies provide a very well diversified exposure to a typical credit-based portfolio.
Okay. Yeah, and that kind of highlights, I've got a slide pulled up now that it's kind of showing the details of how you manage it and why you're typically laddering your strikes and trying to provide diversification, as well as the call, how you're using calls and puts in the strategy. Sometimes you may have strangles or covered calls, or you may just be a bias to selling puts. But the other thing that we haven't highlighted yet is it's that these options are short in duration. Typically 1 to 2 months. I get asked, maybe this is a question, I'll ask you, is I get asked from time to time, like, is there a schedule of when you're rolling them and how you get in and out of from 1 month to the next, where you have the expirations on these, kind of a little bit around those short dated natures. How do you look at managing that in the portfolio with the option expiries?
Right. We typically, as you mentioned, typically keep the options, around a month and sometime extend to, 2 months. But it totally depends on the pricing in the market, obviously in the trends, trends of the interest rates that we want to protect the portfolio from, the rates trending, in one direction. We recognize this environment as we discuss the rates would be, Fed would be reducing rates, possibly in the next meeting, but definitely over next 1 year. So rates could be trending down, but that trend probably would be slow, but could easily manifest over 2, 3 months horizon. So that's why we keep the option expiries short dated, that even if the rates are trending in one direction, but if they're slow enough, then the options still make money, that the prices of the treasuries don't move that much that they would hurt the option portfolio.
Okay. Yeah, that makes sense. And I think this slide right here I really like, kind of explains a little bit about the option positioning and how you did, you know, kind of get your thesis on rates. And it's not necessarily making rate calls as much as it is just having a view on them so you know what ranges you're in and where your bias is to position the option strategy. And as you mentioned, or as we've mentioned, they're short dated. And so as you're laddering those strikes for diversification, you know, because they are short dated, you can always move around your biases or your laddering of the strikes and being able to adjust them on the fly as rates, range move around. I think that's kind of the key thing here that, maybe most, these are range bound strategies that are okay with a little volatility as long as they stay in the range. And I think that's something that maybe over time people don't appreciate how the option positioning and laddering of the strikes works. So maybe, kind of give me a little walkthrough as we look at this slide of kind of your view of how you see not necessarily just going forward, but this year, how it's kind of played out and how you look to position the portfolio through this option selling program. Because it's obviously done a really good job of harvesting yield, especially over the last, 5, 6 months. So this slide kind of shows a little bit about what your thinking is as far as laddering the strikes and adjusting them on a 1 to 2 month basis.
Right. A lot of it depends on the Fed view, which we have been discussing, that there is a general consensus, which we also agree, the Fed Fed is going slowly towards the neutral rate, which is widely expected to be around 3%. But suppose there was a lot of uncertainty about where the rate should be or where it could go, then one would choose a wider, strike range, so to say. But in the current environment, we have a reasonably good idea about where the Fed is going. So which should keep the 10-year rate, reasonably range bound. So with the current, 10-year, if the rates, back up 10, 15 basis points, we have targets for our prices where we would, want to buy more bonds or more treasuries. So we can, sell an option with that strike. That if the rates go to that level, we get delivered those treasuries, and then we can start selling call options on that. So as long as the rates remain range bound, playing with these, strikes sort of like as a target price where you would want to buy the treasuries, can basically, if the market reaches that level, you achieved your target for the desired position. If it doesn't, you just collect the premium. So as long as the rates remain range bound, these strategies keep on collecting extra yield.
Perfect. Yeah, I think that's something that is played out obviously over the last several months, as I said, and now that there is some clarity as far as at least the direction of travel, as I said, is the Fed is easing. There is a lot of fog ahead of how fast and how gradual it will be, but at least there is that you know kind of market consensus or market viewpoint that they are moving closer to the neutral level. Obviously people will debate whether it's 3, 3.5, whatever, but at least we're much higher than that right now. So that bodes well for this type of strategy and the positioning. So it kind of leads into that question, and I'm glad that we got that answer because I think that really is what tells people is we're not making bold rate calls or anything in these strategies. It's more about managing the ranges and rates going forward and the direction of travel and where they're going from, now throughout, not just the end of this year, but into next year. So I think that sets up a little bit of that option selling strategy and how we use it in both the strategies. And really, the only difference between, well, I guess there's the big difference is one, you got a core position or beta position that's the ag, and the other one you got a core beta position that's, money market type securities, treasury bills. So you're just trying to enhance on top of that. Obviously, like you said, more levers to pull in AGGH. Not as many, really just the one that we're doing in buck, but that's why it kind of sits in that ultra short duration space where AGH is more that core bond, and that's kind of right now we're looking at people, obviously 7.9 trillion sitting in money markets. How do people start moving out the curve? And these are two opportunities that we have, for investors to look at that you can start to move your way out the curve as, rates start to trend lower.
Right.
Um, so next up, I think the area that really this is your expertise, and obviously as the CIO of Structural Alpha. So let's dig into this a little bit. And that's we've explained the option selling program. We've explained how we're trying to enhance yield. We're using terms like Structural Alpha. Maybe break that down a little bit and explain, really how you learn these and how you develop them over time in your career and how you're applying them to these portfolios here at Simplify.
Right. So just a little bit of background, this term structural alpha was coined by Bill Gross, our former boss at PIMCO. Basically, idea is that based on demand supply characteristics in the market, certain securities tend to trade, rich or cheap. If there is demand for duration from the pension accounts, from the interest rate swaps, the swaps are trading at a lower yield as compared to treasury. So that, can provide a structural alpha. Or basically, if you want to buy duration, you want to buy in treasuries. And if you want to sell duration, you want to pay swaps. So that is basically, even if your directional view is right or wrong, but you have a good tailwind from structural alpha, then on an average, you tend to do better. So that is the basic idea. And on that theme, the in the fixed income market, the treasury options, as we saw, as we discussed, have a lot of demand supply, imbalance that banks need to buy treasury options to hedge the interest rate risk in their mortgage portfolio, right? So, the sellers collect extra premium. So even if the rate view goes wrong, but if you have extra juice that provides protection, and when your rate view is correct, and then extra, the returns you generate extra returns because of the extra premium available in those securities. That is the basic concept. It is very important to be aware of these structures so that you buy the securities which are trading cheap and sell the ones which are trading rich.
Yeah, thanks for that. And I think what it really makes it unique here at Simplify, obviously, yeah, Bill Gross started at PIMCO and it's been around for a while, but the fact that we've been able to take these institutional grade type strategies, put them in ETF wrappers that now are available to retail investors. All right, really opening up the opportunity set for people to use them now, where in the past it was mostly just through institutional investors through, SMAs and separate accounts and that where there's only access or maybe 40 Act mutual funds. Now we're delivering it here at Simplifying these two strategies through ETFs, low cost type ETFs. So it's really helps bring it to the end investor now. I'm going to go ahead now and share a couple more slides and let's kind of go back to back in time a little bit and the tariff tantrum as we like to call it back in April and kind of go through a little bit. Here's a nice chart of of the move index, kind of go through what happened during that time period. Obviously, we know there was Liberation Day on one week, and then tariffs started coming out on the following Monday. They were much higher, and thus we saw shocks not just in the treasury market, but also in risk assets as far as credit spreads widening and equity selling off. So maybe let's go back and dig into this chart a little bit and just kind of explain how unique these type of moves were over such a short time frame.
Right. I mean, like this was the credit risk event or the risk event for this interest rate convexity strategy. That this event was of the tune of like once in a 20-year kind of a event, not just that the 10-year rate moved 50 basis points in a day and a half, intraday, so to say, but before that, the rates had moved down 30 basis points over, 2, 3 days. So suddenly the rates are going down, and then suddenly they're going back up. These kind of, events are very, very rare in the treasury market, right? So that caused the move to, go higher, and that kind of environment can be very challenging for the option strategy. So we took some hit in this strategy, but we have restructured the strategy with the lower leverage, so that when you run the strategy with the leverage, then you also have to hedge the risk, and the hedging costs in that environment kind of increasing quite a bit. So since then, we have adapted the strategy and made it more robust. That even if that kind of a event happens again, the impact would be much lower. But that event was certainly very unexpected. And the important thing is that the market, which appeared to be very liquid, can suddenly become very illiquid. So it's very important in these strategies to manage that risk. Otherwise, if it was easy to make money through the strategy, then everybody would be doing it, so to say, right? So that's why you need professional investors to manage the risk for these strategies.
Yeah, and I think you brought up a key point there is like this once in 20-year moves, like you've seen, like, the move index intraday moved even higher than my chart here. And it was, to an extent, there was only three other times that it moved as high as it did. So these are like really shocks that are really, one-off type of moves. You don't see that often. And then the other thing that you brought up, and here's the 20-year chart, is rates really, went much lower heading into it. I think people thought we were getting maybe some clarity around the tariffs because they announced the Liberation Day, and then people got shocked that all of a sudden they were so much higher. The base rate was much higher. People were kind of guessing in the maybe the 10 to 20% range, and some of these countries were over 100%, and I think that's what shocked it. And so you saw that move, and the key thing here is everybody always asks, well, you have short dated options in the portfolio so you can adjust for them. Yes, when rate moves are drastic like this over a period of time, but when you get hit in, really it was just a 2 to 3 day, or they put the pause on that Wednesday, and by the end of that Friday, it was so maybe call it a 5 day window where rates moved about 50 basis points. That's an extreme shock.
Right.
And I'm glad you brought up the point where, you see these type of experiences, and then you make your process even more robust than maybe in the past, because that's what these, structural alpha type opportunities, they vary over time depending on market movement. And so in this case, this was a hiccup, but now we've seen the results of it. And now we've seen, coming out of it. And I think that's really what we can discuss next is,
Sorry, one
really
more
about
thing
like,
on
go
the
ahead.
previous chart. That what is interesting looking at that chart, Jason, if you can pull that up again.
The,
Next
the
one.
move index,
The next one, the treasury.
the treasury, there we go.
Right? So, this chart shows, that the treasury rates, longer part of the curve are very volatile. but they're also very range bound, right? The prospects of US economy over a 20-year horizon don't really, change that much. The growth potential and the inflation potential, so to say, right? So what should, one do in a highly volatile but range bound, risk variable? Then one should, just sell options around that range, right? So that is effectively what the option income strategy is trying to do, is capture the premium, the option premium, gets priced in. And while if you can manage the risk for this range, then you can harvest the yield.
Yeah, and I guess that brings, I'm glad you had me bring this back up because that does bring up a good point. So we saw I circled the big move over that, call it that 1 week of, right after Liberation Day, that first week when tariffs went in, and then we had the 90-day pause. So then we saw, a lot of the questions I was getting, because we saw equities, came back pretty quickly. But rates, people are wondering why, some of these strategies didn't recover as quickly. And maybe that, is, something we can get a little deeper in here is, really what we saw is the bond market didn't believe anything was fixed yet. It's just we kicked the can down the road a little bit on the pause on the tariffs, and we still had to make deals. And then as deals started getting made, you started to see the move index, come down some as we saw on the move chart there. So rate vol came down. But rates, if you look at this chart here, they kind of stayed, they came down a little bit, but they kind of stayed elevated and in those ranges as you discussed. And as they moved maybe lower more recently after we got some softer labor data in the summer and then the Fed eased in September, October. But maybe give us a little, back, color about how that helped the portfolio moving forward then as we've seen those rates reset higher in this chart and kind of from there what that meant for the option selling strategy and the premiums.
Right, like this is the reason we choose the 20-year part of the curve, that the shorter part of the curves are dependent on the Fed, and the 30-year part is more dependent on the fiscal situations and the and the issuance, right? So, there are various forces which are pulling the rates up and down, but there's a very small possibility that the rates kind of break this range on the higher side or go too much on the lower side. So I would extend that logic a little bit, to recap what happened during the COVID scenario. Then Fed had cut the rate down to zero, and the rates across the curve had gone down. But since then, we know what kind of inflationary effect that happens. So maybe next time COVID kind of a scenario happens and the central bank cuts the rates down to zero, maybe the longer part of the curve probably won't come down that much. So it would probably stay more range bound than what the experience that we saw earlier. Given that scenario, a 20-year treasury offering a yield of 4.6% and add 1 or 2% through the options becomes a very healthy amount of return for the risk one is taking.
Okay, yeah, I mean I think it's one of the keys is I think going forward as you're right. Do you see like the back end, and this is kind of the view I think we've seen somewhat this year is that the Fed may be able to ease and bring the front end down, but that back end could still, stay elevated due to fiscal dominance and pressures there, inflationary pressures. So you may not see, and we've seen that so far. The Fed cut 100 basis points last year, and the 10-year went up 100 basis points, and the long end stayed elevated. So that's something to realize. Even if rates are going down, that doesn't mean it takes away this opportunity set in the selling of option strategy on treasuries because it may come down a little, but it's gonna, as long as it's bouncing around that range, we can take advantage of it. I added another chart here that I pulled up that maybe you can walk us through, kind of the writing kind of where realized and implied vol is right now. And, because as I said, the move index has moved down. It spiked a little bit over the last couple of weeks, but it was below 70 at one point. It's a little bit above 80 now, but rate vol has come down. But does that mean it takes away the opportunity set for this option selling strategy?
Right. We do data analysis like this to study if the implied volatility in the options is offering enough returns for the potential risk. Like we can see clearly that, in the end part of this curve that the volatilities have been coming down, but you notice that the realized vol is still much lower than the implied. And this is because of the structural flows, the demand supply imbalance results in the alpha opportunities. That this is very much like a insurance business, right? If the insurance company takes a hit from a risk event, they just increase the premiums, right? So when the event happens, the premium goes up, and subsequently the insurance company collects that extra premium. And over time, when the risk events kind of recede, then the premiums start to come down. But net if the demand supply imbalance is there, you always keep collecting that extra premium as compared to the corresponding risk.
Okay. So I think we've done a pretty deep dive on the option selling strategy, structural alpha, and what that all means. Obviously we said there are other levers in AGGH that you pull. So I do have a chart here I'd like to pull up and maybe have you walk through. This is kind of one of the other opportunities and positioning that we've seen really throughout the year in AGGH. So maybe give us a little background on where you see this opportunity and how it's being used in the portfolio right now.
Right. So like in this chart, we can clearly see extra yield available in treasuries as compared to interest rate swaps. A sophisticated investor can take a duration exposure through interest rate swaps or through treasuries, directly owning the treasuries or treasuries futures, for that matter. But, the demand is on the swap side for regulatory reasons. So that's why we see the lower level of there's clearly almost a 1% difference in the yield on the swaps as compared to the treasuries. So simple way to monetize this would be to buy long dated treasuries and pay swaps against that. Simply speaking, if one would buy a 20-year treasury at 4.7% as per this chart and hedge by paying swaps that hold that security for 20 years, and you will have average outperformance of 70 basis points. This is, talking a little bit, taking it a little deeper, is basically one needs balance sheet to buy treasuries, right? So this is a sort of a balance sheet arb, or one can say the people who have balance sheet strength can take advantage of this extra spread, because pension funds do not want to use their balance sheet to get the duration exposure, which is invested in equities and other credit products. They just want the duration exposure, so that's why they just receive swaps. So basically, you know portfolios like AGGH, which have balance sheet. By balance sheet, I mean that the core holdings can be used as collateral against these positions, right? So we can pledge some of the holdings as collateral against the treasuries, or effectively you can just buy the treasury future, which is sort of a collateralized holding, right? So buy futures, pay swaps, and all you have to do is withstand the volatility risk. Size the position in such a way that you can withstand the volatility risk, and you would always have sort of a pull to par kind of effect, and keep adding 70 basis points is a healthy amount of return.
Okay, that's a great explanation and kind of gives a little bit more in depth of, one of the other levers you're pulling. Obviously, we spent a lot of time on the option selling program. And that's kind of the two levers that is pulled the most in these portfolios right now, especially with the backdrop and the opportunity set coming out of the tariff tantrum. Obviously covered a lot right now. So, kind
I
of,
would
I'll
I
go
would
back high
add
level. Go ahead.
I would add one more thing that one of the other large return potential, we have also positioned the portfolio for benefiting from yield curve steepening, right? When the Fed cuts the rate and the long end, stays unchanged because of the issuance due to the fiscal situation, that would result into yield curve steepening, which is also a positive carry or extra yielding, strategy. What that means is even if the curve doesn't steepen, there's higher roll down of the curve in the 7-year part of the curve as compared to the 30-year part of the curve as we saw in that chart. So that even if the rate structure remains unchanged, that adds to additional yield. And if the curve steepens more than what is already priced into the market, that adds to additional returns in the portfolio.
Great, great. And you answered it before I even asked it. I was going to say, was there anything more you wanted to cover? Because we've obviously went pretty in depth here. Two strategies that, although they're alike, they're a little different as well. Go back high level. One really is just a yield enhanced version of the aggregate bond index. The other one's a yield enhanced version of treasury bills, with that structural alpha theme in both of them. Obviously, AGGH, we pull a little bit more levers in there. And Buck really just trying to do the option selling strategy. And really the benefit here is trying to get, more yield without taking credit risk, as well as maximizing total return. And I think both of them have yielded pretty well this year and continue to, maximize the total return as well. Is there anything else that we may have missed or I may have missed asking you that we should go over before we end things?
I would just add that these are time-tested, strategies implemented at our, previous bond investing, at PIMCO. That these strategies are being used for over decades and have added value to fixed income portfolios, and that's why one can achieve consistent performance year after year.
Perfect. I think that's a great way to end it. Just thanks everyone for listening today. If you need any more information, you can obviously visit us at www.simplify.us, or you can reach out to us at info@simplify.us. Thanks again, Shailesh. Obviously, always great to hear you walk through the portfolios and give us a better breakdown of what you're thinking on them. Enjoyed this. Thanks everybody for listening.